Imagine this. You sell a rental property you've owned for years. The profit is huge, but before you can celebrate, you realize tens of thousands of dollars are about to go straight to the IRS in capital gains taxes. Now, what if I told you there's a legal way to keep every single dollar of that profit working for you? To roll it straight into a bigger, better property without paying a cent in taxes today? It's not a loophole. It's part of the IRS code, and it's called the 1031 exchange. In this guide, I'll walk you through what it is, exactly how it works, the rules you have to follow, and how smart investors use it to scale from one small rental into a multi-million-dollar portfolio. And when we get to the end, you'll see how some people use this strategy to build wealth for life and never pay those taxes at all. So let's start at the beginning. A 1031 exchange, named after Section 1031 of the IRS Code, lets you defer capital gains tax when you sell an investment or business property. The catch? You have to reinvest the proceeds into another property of equal or greater value. Here's a quick example. You sell a rental for $400,000. You originally paid $250,000, so your gain is $150,000. Normally, you'd owe $30,000 to $50,000 in taxes. But with a 1031 exchange, you roll that entire amount into another property, and your tax bill, zero, for now. That "for now" is important. It's tax deferral, not tax forgiveness. If you sell without doing another exchange, you'll owe the taxes. But there's a twist later that can make those taxes disappear completely. We'll get to that. Now you might be thinking, why not just sell, pay the tax, and move on? Well, here's the thing. When you keep 100% of your equity, you've got more buying power. More money for your down payment means you can buy bigger, higher cash flow properties. It also lets you scale faster. You can trade up a single-family home into a fourplex, then into a 20-unit building, and maybe you don't even want to scale. Maybe you want to swap into a different market, sell in a slow-growth area, buy in a hot market that's appreciating faster. You can even consolidate, sell 3 small rentals, buy one larger, easier-to-manage property, or diversify, sell one big property, buy several in different locations. And there's one more benefit. When you keep exchanging, you can pass your properties to your heirs at market value. The taxes vanish. That's the estate planning power of the 1031. So if it's this good, why doesn't everyone do it? Because the IRS has rules, and you have to follow them exactly. All right, let's talk rules. And these are not the kind you can bend. First, like-kind property. For real estate, like-kind is pretty broad. You can sell a residential rental and buy commercial property. Sell land, buy apartments, but you can't exchange for your personal residence. Second, the property must be for investment or business use. No flips, no vacation homes you use personally. Third, the 45-day identification rule. From the day you close the sale, you have exactly 45 calendar days to identify your next property. In writing. Fourth, the 180-day closing rule. From the sale date, you have 180 days to close on that new property. And here's a big one. You can't touch the money. Ever. You have to use what's called a qualified intermediary, a QI. They hold the funds between sale and purchase. And finally, equal or greater value. To defer all the tax, you have to buy equal or greater in value and reinvest all the proceeds. Miss one of these rules, and the IRS sends you a nice little tax bill. So how does a 1031 actually play out? It starts with planning. Before you even list your property for sale, you find a QI. You talk about your timeline. You think about the type of property you want next. Once your property sells, the QI holds the money. That's when the clock starts ticking. 45 days to identify up to 3 potential replacement properties. From there, you do your due diligence, inspections, financing, negotiations, and you close within 180 days. The QI sends the funds straight to the seller of your new property. Done right, you've moved your entire investment into a new property with no tax bill yet. Let me give you a real-life style example. An investor buys a duplex in 2010 for $200,000. In 2025, they sell it for $500,000. That's a $300,000 gain. If they sold without an exchange, they'd owe around $90,000 in taxes. Instead, they use a 1031. They take the $500,000 in proceeds, add some financing, and buy $1 million fourplex. Their cash flow jumps from $2,000 a month to $5,000 a month, and they paid zero in taxes at the time of sale. That's how you grow without losing momentum. Now, this is where the 1031 gets exciting, because you can keep doing it over and over. Sell that fourplex in a few years, exchange into a 12-unit, then into a 20-unit, then into an apartment building. This strategy even has a nickname: swap till you drop. You keep swapping properties your whole life. When you pass away, your heirs inherit them at market value. The taxes are gone. But there's even more. You can do a reverse exchange. Buy the replacement property before you sell the old one. It's more complex, but sometimes necessary in a hot market. You can do an improvement exchange. Use the exchange funds to renovate or improve the replacement property. You can sell one property and buy several, or sell several and buy one. The flexibility is incredible if you know the rules. Of course, people mess this up. They miss the 45-day deadline. They try to hold the money themselves. They buy something for personal use. They underestimate how long closing will take. Any of these mistakes can blow the whole deal and cost you thousands in taxes. So is it all sunshine? Not exactly. The pros: massive tax deferral, portfolio growth, flexibility to move markets, potential for higher cash flow. The cons? You have to follow strict rules and deadlines. You must reinvest all proceeds to avoid tax. It can be complex and requires professionals, and you can't use it on your personal home. Still, the benefits outweigh the drawbacks for most serious investors. Let's put this in perspective. You sell a rental for $400,000. You owe $250,000 on the loan. That leaves $150,000 in equity. Without a 1031, you lose $35,000 to taxes, leaving $115,000 to reinvest. With a 1031, you keep the full $150,000 as a down payment. That can buy you a $600,000 triplex. And that jump in property value often comes with a jump in monthly cash flow, sometimes double or triple. If you're thinking about doing this, here's your roadmap. Step 1, talk to a qualified intermediary before you list your property. Step 2, get pre-approved for financing so you're ready when the clock starts. Step 3, know your market and have your team ready, your realtor, lender, and attorney. And step 4, work the plan. Because a 1031 exchange isn't just about avoiding taxes. It's about accelerating your journey to financial freedom. If you found this helpful, hit that like button. It really helps the channel grow. Drop your 1031 questions in the comments, and I might feature your deal in a future video. And if you want my free 1031 exchange checklist, the link is in the description. Until next time, keep building wealth, keep learning, and keep taking action.